Good morning, everyone. I'm back again this morning with Keith Murphy. It's Saturday, and we're coming into the month of May 2020. Just want to say good morning, Keith, first of all, and welcome again. Keith is with Essex Mortgage, lender extraordinaire, 25-year seasoned pro, and lending is his life. And just want to thank you again for your time this morning.
Oh. Thank you for the nice introduction. Happy to be here. And yes, I am a self-professed mortgage addict. And I think you'll see a little bit about that today as we talk about interest rates and points and such.
Terrific. Before we do that, I just want to tell you and the rest of our watching audience something that I just listened to this morning from Jim Quick. He just came out with a book called Limitless, and it seems to be his analogy, I felt like this morning was particularly germane to this time that we're going through. And he was saying that you have a choice, that you can either be a thermometer or a thermostat. And in being a thermometer, you're reactionary. You just react. You react to what's going on out there. Whereas a thermostat sets the pace. You keep your same temperature no matter what's going on around you. So if it gets hotter and you're set with the air conditioning at 72, you adjust and you cool down. And if it's getting colder and you need to adjust, you adjust and you warm up. But you want to be the thermostat, not the thermometer.
Yeah.
Anyway, I just thought that was really great. I loved it.
Me too. I love the thought of neutrality, especially when things get really crazy and wonky like they are right now in the world. It's better to recoil a little bit and stay neutral and balanced in your view on things and thoughts on things and your reactions to things. I'm gonna have to pick up that book. I wrote that one down. Limitless by Jim Quick.
Yes.
Awesome.
Yeah. Anyway, so we decided that we were going to take a few moments to really dive deep, a little deeper than we have in the past, on points and what they are and how you can how it can benefit you if you elect to maybe step up and pay a point or two to be able to get that rate adjusted. So go ahead, Keith, take it away.
You betcha. Well, I think it's first very important for who's ever watching this to understand what drives a mortgage rate up or down on any given day. You could log onto the internet, see a billboard on a freeway, hear a radio ad, a TV spot, and it seems like, there's an interest rate advertised, but behind that interest rate, like what are the dynamics and what's going on? So I'm going to attempt, this is my first time doing this, Kelly, I'm going to attempt to share my screen for a minute, and I want to show everyone a live trading screen. Can you see?
Oh, wow. Yes.
Can you see this?
Yes.
So this right here, this little box is a real-time chart of the Fannie Mae 30-year coupon as it's trading on the Chicago Board of Trade right now. And what you're seeing here is the price of the bond. So think of it like this. If you were to go into a bank and buy a savings bond for $100, that, let's just say for round numbers, was earning 1%. And then a few months or years later, you want to go into the bank and you want to redeem that bond before its maturity date. If the new issuances of $100 savings bonds are now paying 5%, they're not going to give you face value for your $100 savings bond paying 1%. You're going to have to discount your $100 price point down to whatever equals a 5% yield. I don't know if that makes sense. There's a little bit of algebra. So back to the screen share here. This is showing the bond prices.
Let me just interrupt you and repeat what you said from my more layman's point of view. If I understand you correctly, if I purchased a $100 bond, that bond, what I pay for that bond is $50, for example, and in 10 years it's going to be worth $100. But if I go in 3 years from now and I want to redeem that $100 bond, I'm not going to get $100. I'm only going to get maybe $58.33.
Right.
Okay.
That's if interest rates have gone up because future bond prices went down. The reverse is true. If bond prices go up higher, meaning there's more appetite, more capital going after these bonds, driving the bond price up and the yield down because it's an inverse relationship, then in that same example, when you went back to the bank to redeem your bond early, when the new issuances are delivering a yield that's less than what your bond or savings bond yields, you're going to get a premium above what you paid for it, even though you're redeeming early. So mortgage rates, the bottom line is that mortgage rates are driven by the buying and selling of mortgage-backed security instruments or bonds. They're a fixed income instrument that hedge funds, mutual funds, endowment funds, basically big money ETFs, they're buying these mortgage bonds along with treasury bonds to get their capital protected and earn a small rate of return or yield while they're sifting through other investment opportunities. So basically what I tell clients is when you see the stock market going down, that means there's an elevated risk in the market because people are selling off their stocks, and these money managers are going to move their money into mortgage bonds and treasury bonds and corporate debt to protect their capital and still earn a return. When it's time for the stocks to rebound and you think Apple's now cheap, McDonald's is now cheap, I better buy some of that because it's going to go back up. You sell your low yielding bonds, you buy the stocks and ride the wave back up. That arbitrage and that capital flow is what drives mortgage rates. So it's interesting if we look back at this screen, this is just the price movement since 5 this morning when it opened Pacific Standard Time. This is back in the Chicago Board of Trade. You can see that just in the first few hours of trading, the bond price has come down. There's either too much paper coming to market or there's not enough buyers for the bond, or both. It's a supply demand thing. But now let's open this up and look at a 2-day chart, a 5-day chart. So now look here. Last Friday, bond prices were lower than they were yesterday at about 4 p.m. Pacific Standard Time. And this morning here, they opened up really in the same range, and then they've since been trading off. All I'm trying to point out is that mortgage bonds move dynamically with the market in real time, and corresponding interest rate is going to be different. So when clients hear an interest rate advertised, it's not just about the points, which we're going to get into next. It's also about, well, when did they record that ad or post that video? Because as you just saw on the chart, these prices are changing minute by minute every day that the market's open. So if you're hearing the same interest rate advertised on the same advertisement on the radio for the past 2 weeks, you know that something's not right. Yeah. There's no way that same rate pool could be the same every single day.
Yeah.
Does that make sense?
Yes,
Okay.
absolutely. Absolutely. So that's why it's that rate is no longer there.
So now I'm going to real quick show you, and I've taken the client's name off of this, but this is actually one of your clients, Kelly.
Oh, okay.
This is a rate watch report that I prepared on the 16th of this month.
Mm-hmm.
So now what I'm going to talk about is every single day that market is setting a price for what the corresponding interest rate is on the mortgage bond, whether it's a 30-year bond, 20-year, 15-year. There's different prices and different corresponding yields. So your client elected to purchase a home with a 15-year fixed, and they wanted to know, well, what are our options? Where are the interest rates and what are our options? And my answer was, well, it's America, So you get to pick which interest rate you want. I'm not going to tell you what the interest rate is. You're going to decide what works best for you. And I prepared this report for them to show them that on April 16th, today's May 1st, okay, so things have changed, but they could buy this home for $375, put 20% down and have a loan of $300,000. Let me see if I can make this a little bigger. Can you see that?
That's
better?
great. Yeah, perfect.
And at that time, it showed that I could deliver and lock in an interest rate at 3.25%, and they wouldn't pay any fees to get that interest rate. That doesn't mean they wouldn't have any closing costs for buying their home. They still have fee, escrow fees, title fees, appraisal fees. This is just for the rate. And
right.
So I showed them you could lock in today at 3.25. You could pay $348 extra and get it to 3.1, or you could go all the way down to 2.5% by paying a couple of points, which is equal to this cost of $64.23. And their reaction was, well, what do you think we should do, Keith? I mean, what would you do? And I said, well, it's all about time. How long do you plan to be in the property and in this loan? And then let's see what the break-even point is for each interest rate rung on the ladder here, if you will. So what this basic formula shows is if they were to pay, say for instance, 3.125, they pay an extra $348 in closing costs. Based on the payment savings, because it's a lower rate, they'd have to stay in the loan for 1.6 years or 19 months. And at the end of 15 years, that buy down would have returned $61.96 in interest savings. Does that make sense?
Yes.
So as you can see, it's not a linear equation, meaning just because you go down eighth by eighth by eighth, the corresponding cost is not linear.
Right.
And that means that the break-even period is not linear either, meaning it's not a consistent spread. But the bottom line is this: if someone's looking to refinance their home or purchase their home, points get a bad name. They're not, it's just prepaid interest. You're buying down your rate early. This is a tax deduction. And then you've got to look at, well, what type of return on capital, what kind of return on my investment here for my buy down am I going to get in the form of interest savings? And how many months or years will I need to be in the loan to make this return, break even, and then make the return? Does. That's what someone who's consulting a client does to help them decipher what's going to be the best investment choice for them. And in this case, your clients are going to be in the home for a minimum of 10 years, probably closer to 15. And it was a no-brainer for them. They said, listen, we'll put the $6,000 into the closing costs right now. We'll get this rate down to 2.5%, which is less than inflation. Think about that. They're getting free money here. And at the end of their 15-year term, they're going to have saved $32,000 on their $6,000 investment. And that's a guaranteed return. There's no market fluctuation influencing that. So you said you wanted to go deep. There you go. Do you think you can think of any questions that people might have on this?
Well, I think one of the important things that I just, as a former banker and strategically, what I always like to point out with my clients is, although you buy emotionally and you buy for what's going to fit your family, but there's the business part of it that you and I need to also point out to them is that when it comes to the loan, which is the way that most people pay for that home that they purchase, the had a connection in unstable. But the point there was that even over 30 or over 15 years, the total interest that they were going to pay, even at 2.5%, was $420,000, which was more than 100% of the total purchase price of the home. So you've got $300,000 that they're borrowing and $420,000 that they're paying, of interest that they're paying on, or that they're paying, there's $720,000 plus the $75,000 that was their down payment. So we're up to almost $800,000 that they're paying over time. And so anything you can do to save interest is you're paying less for that property over time. And I always think about that being part of the big equation, and I know you do too, and that's why I appreciate you bringing this option to them. So yeah,
unless you're 100% right, unless you're paying cash, the price of the home and the overall cost of the home are two different equations and two different sets of numbers.
right.
So that's where some of these interest rate buy down options can be really powerful and give a good return on investment. Conversely, if clients think they're not going to be in the loan for very long, it's a temporary housing situation, or they feel like the market interest rates are going to improve going forward and they might refinance into even a lower rate in the somewhat near future, they may elect to not do points. Conversely, also, you can go, and that spreadsheet I showed doesn't show that, but you could go above the market rate and actually get yield spread premium or lender credits to cover closing costs. So there's, a whole myriad of ways to take a look at your mortgage financing.
Mm-hmm.
And that's why I think it's important that you really analyze all of your options. I think most clients are just sort of conditioned. That's kind of like all we know is you get on the phone and you talk to your lender and say, well, what's your best rate today? Well, what does that mean? Best rate on what product? What's your financial goals? Are you trying to preserve capital and invest it elsewhere? Or do you want to, put the biggest amount of money down to get the lowest monthly payment? And then how do the different interest rate options tie into your financial goals? Those are the type of things that people should be, I think, analyzing when they're taking on such a large amount of debt, because just moving the needle a little bit, as you can see in that spreadsheet, can save a lot of money or cost a lot of money, depending upon how you look at it.
And the beautiful thing is, frankly, I feel like when my clients work with you, you do that analysis for them and present them with a couple of different options. And that's where they make that choice.
They don't know it on the front end, but they don't have a choice. They're going to get options and they're going to get educated so they can make sound decisions.
Mm-hmm.
And then at the end, they're really typically appreciative of that, but they didn't know on the front end what was going to happen.
Right. One question that I did have for you.
Yeah.
I did have a quick question for you, and I know that you've got to get going to another client meeting, but we looked at a conventional scenario where this particular purchaser had their 20% down. What if we're looking at something that is FHA, VA, with less than 20% down, or 5% or a 3% down conventional? Do those folks also have that option of doing rate buy downs or getting premiums? Okay.
Yeah, great question. It doesn't matter what the loan program, conventional, FHA, VA, USDA, or what the down payment would be, 3%, 5%, 0%, 20%, 50%. And it doesn't matter what the term of the loan is. Yeah, you always have these interest rate buy down options. Again, because the market's moving very dynamically, those spreads between each eighth of an interest rate are going to change moment by moment, as is the corresponding interest rate.
Great.
Until you're locked in, of course.
Mm-hmm. And I just want to point out that I know what as you said, a loan addict you are. I know that you sit and have that screen up on a separate screen all day long, and you're watching what's going on. Where is it? Is it time to lock? Is it time to, or should we be thinking about locking? Or what's the trend that I'm seeing? Maybe we just hold off a little bit. So I know a lot of our clients have really appreciated that as well. So
yeah, I actually really enjoy it, but I just also think it gives me a finger on the pulse of the market. And when you can see spikes in volume and the price is moving either up or down on that volume, and then you start to see things build and contract, you get a real good vibe if you're watching it all day. I don't just stare at it, but I'm keeping an eye on it all day. And I can give educated advice like, listen, we wouldn't be in a position where we want to lock today. The market's improving. Bond prices are going up on bigger volume than we had yesterday. And so we should continue to float and let this trend continue to deliver us better pricing. Or conversely, there's profits being taken, the bonds are being sold off because of capacity issues or shifts in sentiment as far as fear or greed. And if we wait too long, we're going to see our pricing get away from us and our interest rate go up. So one of the key takeaways that I've learned in my career is if the client likes the pricing, they like the rate, regardless of what the market's doing, they should just lock it, because you'll never look back and be disappointed if you're protected throughout your transaction, knowing you got the interest rate, the payment, and the terms that you were looking for.
Fantastic. Thank you so much. Keith, I know you have to go, so I'm going to go ahead and sign off, say thank you again. Have a great weekend, and we'll be in touch real soon, I'm sure. So thank you again.
Enjoy your Saturday, Kelly.
Thanks, you too.